Okay. So the meeting's been recorded. So we start right away. We give some small notes, then we do a question. So at least we do 2 questions, which are comprehensive, which will cover everything. So replacement analysis. So replacement analysis, we say refers to decisions to replace an old machine with a new machine. So we refer to the decision available to replace an old machine with a new machine. Reason for replacement, we talked about them. One of them is because of change in technology. Change in technology as one of them. So we're not going to repeat that one. So those reasons you can verify in our previous classes. Okay. Sorry, replacement analysis. Najua ionekani hapo. So replacement analysis will refer to the decision to replace an old machine with a new machine. Okay. Cash flows to be considered. Cash flows to be considered. To be considered. Number A, incremental total initial outlay. So incremental total initial outlay, this represents the total amount of investment of that project. So at the year 0, so the total cost of the project. So we call the incremental total initial outlay. So we can say this refers to capital in present value. So this refers to the capital in present value that is required by the company. That is required by the company. By the company in order to implement it, in order to implement replacement decision. You have to make the reason. Format. Let us talk about the format. So we need to start with purchase cost. Purchase cost. Once we have the purchase cost, we add incidental cost. Incidental cost. For example, we can have installation cost. Installation cost. We can also have insurance cost. Insurance cost. Flights. Duty. So when we talk about incidental costs, these are the costs which are incurred even before the machine is in use. So even before the machine is in use. So freight cost, import duty. Import duty. Then we add them together. So purchase cost plus incidental cost. So you get what we call effective. Effective cost. We can get effective cost. Then We add working capital, add working capital. So we add working capital. Okay, once we add working capital, we add overhaul cost. Overhaul cost. Overhaul cost. Then we add or reduce gain, gain or loss in tax recapture. It's either we add a gain or we less a loss, or we less a loss, or we less a loss. Then we less the market value. Less the market value of old machine so we less the market value of old machine, and then once we less the market value of old machine, then you can get the incremental total initial outlay. So incremental total initial outlay. That's how we find the total cost of our project when we are doing replacement analysis. So we start with the purchase cost, we add the incidental cost. And tumesema incidental cost are those costs which are incurred before the machine starts to operate. We get the effective cost. Once we get the effective cost, we add working capital. So working capital, this is the day-to-day capital required for a farm. Then we also add overhaul cost. No, overhaul costs are future costs that we expect from that machine in the future. So the overall cost must be discounted to present value. You must bring them to present value in that case. Then we add or less gain or loss on tax recapture. So how does it arise? So gain or loss on tax recapture arises where the company disposes the old machine. If the company disposes the old machine, we shall have gain or loss on tax recapture. If the company has not sells the machine, we shall not have gain or loss. We shall not have. So appears when this appears when the company does what? Either sell an asset. NB, let's talk about NB. Number one, gain or loss on tax recapture. NB, 20 apple. So gain or loss on tax recapture. So gain or loss on tax recapture. And you can say it refers to tax effect which arises during the disposal of old machine. So you need to remember tax recapture arises where the firm sell a machine, an old machine. It is given as follows. The formula: gain or loss on tax recapture. Gain or loss on tax recapture. So it can be either the gain or loss or disposal of old machine we multiply with the tax rate. Multiply with the tax rate. We multiply with the tax rate. And then gain or loss. So how do we get this one? Gain or loss on disposal of old machine. Gain to loss on disposal of an old machine. Gain or loss on disposal of an old machine. Then that will be equal to sales proceeds. Sales proceed minus net book value. Net book value. Sales proceed of old machine. Old machine. Net book value of old machine. So that's how you get it. So gain or loss on disposal of an old machine, you go to sales proceed. And then how do you get the net book value? Now, net book value of old machine. Now, net book value of old machine can be equal to cost of the old machine with less accumulated depreciation. With less accumulated depreciation, with less accumulated depreciation. NB, overhaul cost. Refers to cost of repair and maintenance in the future. And then it must be discounted it must be discounted to present value. It must be discounted to present value. Another thing we need to know is that effective cost, NV, another NV, effective cost. Effective cost, this one, I'm talking about this one. You can see this one, effective cost, this one. Effective cost is used to calculate depreciation. It's used to calculate depreciation. Depreciation of new machine. So effective cost is used to calculate depreciation of old machine. Aya, tusonge. We'll go to the other side. So continue from that side, or we can use this space first before we go to the other side. So kama create some space and kidogo, you just move to the other side. Sawa sawa. So we continue. So that's all about effective cost. We need to remember that one also. Now, even before we let us talk about incremental terminal cash flow. So that one is number one. So number 8 we now. So number 8 was incremental total initial outlay. Let us go to number B. Nikiweka tu hapa. I think itatoshea. Itatoshea definition. Acha tuweke hapa itatoshea definition. Then format tutaweka baadaye. Let's put it there. Hapo sawa. So hapo itatoshea. Let me do that one. Incremental terminal cash flow. Because incremental number B. Incremental terminal cash flow. And then remember, when we talk about terminal cash flows, we say that this is a cash flow So, for example, if a machine is expected to be used for the next 5 years, then at the end of that 5 years, the machine can be disposed. So
No, ndio hivyo.
Sorry. We continue. So, sorry, we are continuing from the incremental. Let us give the definition. So the definition for incremental refers to the cash flow that is going to be generated at the end of the economic life. The keyword is the word at the end of the economic life. So it refers to the cash flow. The cash flow that is expected to be generated Sorry, nimekuwa na issue hapa fulani. Sorry for that. Uh, Nimepata some issue kidogo. So sorry for that. Let us continue. So, I was saying that I was saying that this is a cash flow expected to be generated at the end of the useful life of the asset. So refer to the cash flow that is expected to be generated at the end of economic life of the asset of the machine. Let us use the word machine because we are in a replacement. Because we are in a replacement, let us use the word machine. Let us use the word machine. So the cash flow expected to be generated at the end of the economic life of an asset is what we call the terminal cash flow. So cash flow is expected at the end. Now move to the other side, kidogo. Move to the other side so that we can make use of space. So space is very important for now. So we need to make use of the space. Let me give you the theory part, then we shall do question tomorrow because but in emergency. So let me give you the note. Let me complete on the note, Kabisa. Then we do questions tomorrow. So sorry for that. Nimekuwa na up and down. So how do you compute the incremental terminal cash flow? We start with working capital. Working capital. This is how we compute incremental terminal cash flow. So we start with the working capital. Then we add incremental salvage value. Then we add incremental salvage value. So we add incremental salvage value. And how do we do it? We start with the salvage value of old machine. Salvage value, no, salvage value of new machine. Of new machine. Of new machine. Less salvage value of old machine. So fika tunapata unaiweka hapo. Then una add na ile ya working capital. So we shall get the incremental cash flow. Incremental terminal cash flow. Terminal cash flow. So that's how you come up with the incremental terminal cash flow. That's how you come up with the incremental terminal cash flow. And then number C, as our last one. Number C, incremental net operating cash flow. Incremental net operating cash flow. So incremental net operating cash flow. This is referred to the external benefit that will be generated by the new machine during the normal operation of the business. So this refers to expected benefits that will be generated by the machine during the normal operation of the business. During the normal operation of the business. So that benefit that the firm expected to get from the normal operation of the business. From the normal operation of the business. So we are saying this refers to the expected benefit that will be generated by the machine during the normal operation of the business. Then it is determined using two methods. It is determined using two methods. It is determined using two methods. Number one of the methods we call it depreciation method. Depreciation method. Number two, depreciation tax shield method. Depreciation tax shield method. Depreciation tax shield method. So tuende na ya kwanza, depreciation method. So turudi huku. We talk about depreciation method. So depreciation method, so depreciation method. So in this method, we start with the sales or we call it revenue. Let's call them revenue. That is the revenue, the less variable cost. We get the I need to less variable cost. We get contribution. Once we get contribution, we less fixed cost. We shall get earning before depreciation and tax. So that's really less depreciation. So we less incremental. Yeah, incremental depreciation. We shall get incremental earning before tax, the less tax. We shall get incremental earning after tax. Then we add back. We add back incremental depreciation. So we add back, we shall get incremental net operating cash flows. So that is the depreciation method. That is the depreciation method. That one is the depreciation method. So you go to the other method, which we call it, we usually call it tunaitaje? Depreciation tax sheet method. Depreciation tax sheet method. So we do it here. So number 2, depreciation tax sheet method. Depreciation tax sheet method. Tax sheet method. So tunaanza na revenue. Revenue. Our revenue less variable cost. Less variable cost. We get contribution. We get contribution. Once we get contribution, we less fixed cost. We less fixed cost. If we less fixed cost, we shall get incremental earning before depreciation and tax. Now, in this case, we less tax. We less tax. Once we less tax, we shall get incremental. We shall get incremental earning after tax. Then we add incremental. We add incremental. We add incremental depreciation tax sheet. So we add incremental depreciation tax sheet. Then our final answer will be incremental net operating cash flow. Incremental net operating cash flows, which must be equal with this one. So these two must be equal. So those two must be equal. So kutumia hii method upate hapa, na kutumia hii method upate hii, the answer is the same. So the answer is the same. So whichever method you use, the answer will be the same. Will be the same. So incremental tax shield. How do you get incremental tax shield? NB. NB. So incremental tax, incremental incremental means this one, incremental depreciation tax shield. Depreciation tax shield. How do you get it? How do you find it? You take the depreciation, you multiply the tax rate. You take the depreciation, you multiply with the tax rate. You take the depreciation, you multiply with the tax rate. You take the depreciation, you multiply with the tax rate. May 2018. Let's go to this one, the normal one, ya kawaida. May 2018. May 2018, question 2B. May 2018, question 2B. Let us do two questions. Au kisha tufanye moja to introduce another topic. Na some item, kuna some item sijafanya. So May 2018, So umefika hapo? Yes, May 2018 question number 2B. May 2018 question number 2B. May 2018 question number 2B. So open that question. So let us continue. So May 2018 question number 2B. So let me do away with this one. Then I read the question. So the question reads in this way. Kakusu ATD is contemplating acquiring a new machine to replace the current one being used in production process. The existing machine was acquired 2 years ago at a cost of 80 million. The existing machine was estimated to have a lifespan of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years. The salvage value of 1.5. The existing machine can be disposed at 4 million. The new machine is expected to cost 12.5 million with a salvage value of 4 million at the end of the useful life of 5 years. The machine is expected to require an additional investment of working capital of 2.6 million at the end of the useful life, which will however be recovered at the end of the useful life. We have the EBIT for new machine, the existing machine. Cost of capital is 13%. The company price method of depreciation tax is 30%. Required, you are supposed to determine NPV. So let me start with this question. So we start with the question. Sawa. So we start with we determine number one. We start by determining incremental. 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 So nimetoka nje. Hapo. Incremental. So we start with Start with incremental. Total initial outlay. So we start by computing total initial, so incremental, total initial outlay, and we said we start with the purchase cost. Then we start with purchase cost. So what is the purchase cost according to the question? Now, according to the question, the purchase cost is 1256. So this one is for new machine. Remember this one. Remember, it's for new machine. For new machine. Remember, it's for new machine. So it's 12,560,000. 12,560,000. Then we add incidental cost. Incidental cost. Now, according to this question, we don't have any incidental cost. There was none. It's 0. So we add, we get effective cost. Effective cost as 12,560,000. Then after that, we need to add working capital. So we add working capital. So we are supposed to add working capital. So tumesema ni May 2018. May 2018, question number 2B. May 2018, question number. May 2018, question number 2B. Now we add working capital from the question. So from the question, you can clearly say that working capital is, let me see. So our working capital, it is very tiny. Additional investment of working capital of 2.6 million will be required. So 2.6 million, which is 2,600,000. Then we don't have anything here. We either add or less gain or loss on tax recapture. So it can be a gain or a loss on tax recapture. On tax recapture. Let us do it here. We find it here. So gain or loss on tax recapture. Gain or loss on tax recapture. So gain or loss on tax recapture, how do you get it? My good friends. Now, it is either we suppose for the formula for gain or loss on tax recapture, it is either you gain or loss on disposal of old machine, removal with the tax rate. Nilikuwa nimewambia pale nyuma. So gain or loss on tax recapture. Sorry. So tunasema hapo inaonekana. So for us to get the gain or loss on tax recapture, sawa, I think hapo iko sawa. So tunasema that for us to get the gain or loss on tax recapture, we take the gain or the loss on the disposal, we multiply with the tax rate. But before we get that one, we need to find this one, gain or loss. We need to find this one, gain or loss. Gain or loss on disposal of old machine. So tukasema ni sales proceed minus net book value. So sales proceed tunajua kwa swali, we have it. So the machine can be sold at the end of the useful life at 4 million. I think that one is in the question. 4 million is the question. Now we need to find net book value. And we say is the cost minus accumulated depreciation. Remember cost of old machine. Remember this one is for old machine. Remember it's for old machine. For old machine, the one we are selling. So we are selling the old machine. So what is the cost of the question? The cost of the machine initially. How much did they bought the machine? Now, if we go back to our question, the machine was bought at a cost of 8 million. So so it was bought 3 years ago at a cost of 8 million. So it is 80 million. Now we need to minus accumulated depreciation. So what's the formula for accumulated depreciation? Formula for accumulated depreciation. Let me put it hapa chini. Accumulated depreciation is given by cost minus salvage value over useful life. Then you multiply number of years in use. Number of years in use. In use. So what is the cost? So the cost is 8 million. Sorry, about 8 million. 8 million. We less our salvage value. So what is the salvage value of the old machine? So hawakutupatia. So hawakutupatia the salvage value. Wametupatia the salvage value for year 5. Oh, with no salvage value. So there was no salvage value. So it's 0. 0. Useful life. So the machine was expected to be there for 5 years. But it will make up how many years? How many years is the machine used? So the machine, kulingana, let me read the question again hapa. Wanasema, the existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a life for 5 years with no salvage value. So it required it to make up for 5 years with no salvage value. But it will make up how many years? So the number of use. So it was only used for 2 years. So what is the accumulated depreciation? So 8 million minus 0 divided by 5, then as 12 na 2. Inakuwa ni 48. 4.8. So we less 4.8 as our net book value. So what will be our net book value? So 8 million minus 4.8. So 8 million minus 4.8. Itakuwa calculator. Tunasema 8 million minus 48 00. So inakuwa 3.200,000. So 300,000. Now tukija pale book value, so tutakuja hapa kwa gain. So let us find this one now. Let's find out this figure because we have all the figures. So gain or loss on disposal itakuwa sales proceed. So from our question, they can sell it at 4 million. We minus our net book value as 0.2. So what will be our, so it will be a gain. This one will be a gain on disposal. Gain on disposal of 800,000. So they shall sell it at a gain. Now, let's now get this one. Gain or loss on tax recapture. Gain or loss on tax recapture. Recapture. Which is 800,000. Tomorrow the tax rate. So our question says tax rate is 30%. So 80% of 30% is to 40,000. To 40. So we add here to 40,000 as our gain or loss on tax recapture. So we add it here. And then, do you have anything else? So to add working capital. So we less the market value of old machine. We less the market value of old machine. Na tulikuwa nayo hapa iko wapi? Si ndio hii? Ndio hii. Sales proceed. Which is 4 million. So we less this one. So to less, we shall get the incremental total initial outlay. Total initial outlay. So how much is that? So according to be napata 10, 9, 20,000. 10, 9, 20. 10,920,000. 10,920,000. So that's number A. Tumefanya number A. Then number B. Terminal cash flow. Let's determine terminal cash flow. Terminal incremental cash flow. Now what was the formula? We said we start with the working capital. Working capital. What's our working capital? So our capital ndio hapa. 2.6 to 2,600,000. Then we add incremental salvage value. Incremental salvage value. So how do you determine this one? We start with the salvage value. Salvage value of new machine. Now from the question, what is the salvage value of the new machine? So salvage value of the new machine. Sende kwa hiyo swali yetu. So 4 million. So pale chini. So the new machine is expected to cost 12.56 million with an expected which is expected to be sold at 4.6. So pale chini. So 4 million. And then we less salvage value of old machine. So what is salvage value of old machine? So that one, salvage value of old machine, 1.5. You come on, Iona. So 1.5. So what will be the incremental cash flow? So incremental terminal cash flow. So incremental terminal cash flow. So how much is that be? 100,000. Is that one fine? I think hadi hapo tuko sawa kabisa. So that is part B. So we can go to part C. We can calculate the incremental net operating cash flow. So incremental net operating cash flow. So incremental net operating cash flow. So allow me to do away with this one, to go to the next part, Apple. So next, I want to do incremental net operating cash flow. Incremental net operating cash flow. Incremental net operating cash flow. Now, we need to start from where? From sales. But our question, imeanza from where? Let's go to our question. So tukirudi kwa swali yetu, kwa swali yetu imeanzia kwa earning before depreciation and tax. So we need to find the difference between the existing and the new to get the actual amount. Sawa. So this one, according to the question, our cash flows haijaanzia kwa sales. In this case, imeanzia kwa earning before depreciation and tax. So pale wametuambia earning before depreciation and tax. So imeanzia hapo. And then we have new and existing. So this one will be equal to existing, EBITDA of new machine minus EBITDA of old machine. So unafaa ujue hiyo. So you need to know that one. So new minus old. So tuanze. We have years. So year 1, 2, 3, 4, 5. It was supposed to be used for how many years? For the next 5 years. So find the difference between the two. So 54 minus 32. So 5400. Kumbuka hizo ni in thousand. Kumbuka in thousand. So tunaanza na EBIT, earning before depreciation and tax. So the difference between the two. So 54 minus 32. Itakuwa ngapi? itakuwa 22. So let me jaza. So in the difference between the two, so itakuwa 2200, then 2600, 2400, 3000, and then that 3400. Okay. Less incremental depreciation. Let's incremental depreciation. Let's do a working here. So incremental, we want to do working of depreciation. So incremental depreciation is equal to depreciation of new machine minus depreciation of old machine. Depreciation of old machine. Start with the new machine. So depreciation of new machine. So depreciation of new machine. So to get depreciation of new machine, remember it is the effective cost. Effective cost minus salvage value over number of years. Number of useful years. Aha, itakuwa ngapi? That depreciation of new machine. So what is the effective cost? Effective cost ndio hii hapa. Ndio hii hapa. 12,560. 12,560,000. Iko hapa juu. So 12,560 mnaiona? Salvage value. The new machine has add a salvage value of how much? Of 4 million hii hapa. Salvage value of new machine ni hii hapa 4 million. So we need to raise 4 million. Then the useful life supposed to be used for the next 5 years. So what is the depreciation there? So 12,560 minus 4 million divided by 5. So what's 17,12,000? 17,12,000. Then you need to also find the depreciation of old machine. Now, depreciation of old machine, you start from the point where they say a critical analysis was done. A critical analysis. Let me read that statement. When you want to say a critical analysis is done, that is where we start calculate depreciation of the old machine. So tunachana za kitambo. So up to the point where hii machine iko kwenda mbele. So let me read that part. Let me read that part. Inasema pale juu. The existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life for 5 years with no salvage value. Up to that point, inasaidia kupata depreciation of this one. The one itatumia kudetermine accumulated depreciation. So hiyo mpaka hapo tumesoma hadi hapo ni kudetermine accumulated depreciation, itasaidia kupata the net book value. We are not interested with that depreciation because that one is before. But now, listen now. However, a critical analysis of machine now shows the machine can be used for the next 5 years. From today, kutoka saa hii, we are not interested with the kitambo. So for this depreciation for the machine, we are interested for that depreciation of the machine from today towards future. Anything in past, we ignore. Now let us do it. So now a critical analysis, however, shows that the machine could be for the next 5 years. The salvage value of how much? 1.5. So it can be have a salvage value after 5 years. After 5 years. Now, this is the formula. Because it is today, na hii mashine ilikuwa kitambo, so imetumika kutoka kitambo ikafika leo. So leo wana estimate itatumika for another 5 years. So this cost yenye ilikuwa initial kitambo, we shall not use it. We shall use this cost yenye iko hapa. And which is that cost is the net book value. So hapa natumia net book value minus salvage value over number of life, number of useful life. So what is our net book value? Tulikuwa tumepata tulikuwa ngapi? Net book value tulikuwa tusha calculate pale nyuma, so I don't need to calculate it again. So the net book value was what? Net book value ilikuwa ngapi? 32. I think it was 3.2. It was 3.2 or 4.8. Someone to confirm for me. This is supposed to be 4.8. We minus our salvage value, which is 1.5. Then you divide by 5. So the old machine was estimated to have an extra 5 years. Total. So itakuwa ngapi? Itakuwa 660,000. This one is 660,000. So depreciation of old machine. Now let's find the incremental depreciation. So we have said depreciation of new machine, which is 712,000 minus 660,000. Minus 660,000. How much is that mean? 1052,000. We could 1052,000. And because it's straight line, the depreciation will be the same from year to year. The depreciation will be the same. 1052,000. So you go in thousand to get 1052. 1052. 1052. 1052. 1052. So the depreciation will be the same because it's a straight line basis. So we can get here incremental earning before tax. Before tax. Before tax. Now if we left so 2200 minus C of 1148, 1548, 1348, 1948, 2348. Then we less tax 30%. So 30% of this amount. So 30% of 1148. So 30% of 1148. Itakuwa 803.6. 30% of 1548. 464.4. And then 30% of 1348. 44.4. Then 10% of 1948. 584.4. Then 10% of 2348. That was 704.4. So we can get incremental earning after tax. Incremental earning after tax 803.6. 26, 1083.6, 943.6, that is 53.6. So that is 16.0.6. So ukisha to that one, we can add back incremental depreciation, so that we can get what? Incremental net operating cash flow. So we'll add up at 1052, 1052, 1052, 1052, 1052. So itakuwa ngapi? We add them together. So itakuwa 1855, 26, 21, 35.6, 1995.6, 2415.6, 26, 95.6. So those are the net operating cash flow. So those are the net operating cash flows. Now, once we get the net operating cash flows, we can proceed and get NPV. So that this question will be over. So how do we get NPV? So NPV is equal to incremental net operating cash flow. We multiply with the present value, interest factor for any period. We add terminal cash flow. So present value, interest factor for period 5. So you make a period 5 intentionally, then we minus incremental. Let me shift the screen kidogo ndio itoshe hapo. I think that one will be visible. So we're supposed to less incremental terminal incremental total initial outlay, total initial outlay. So ukiwa na hiyo, then hizo tumemaliza. Cost of capital ilikuwa ngapi according to the question? Cost of capital, it was 15%. So cost of capital 15 or 13. Let me check. I think it is 13%. So you can either use the table or you can insert direct. So it is you to decide. So, it is 13%. So it is 13%. So means to me table, me natumia direct. So NPV will be equal to, so itakuwa ni 1855.6 multiply with 1 plus 0.3.13. So hii plus inakuwa test negative 1. So for year 1, test negative 1. So hii plus ni 1 point. So hii kuliko niweke hivyo itakuwa nikiweka 18 55 26 1.13 -1 plus huyu 21 35.6 1.13 -2 plus next 19 95.6 1.13 is -3, then 24 16 1.13 raised to -4 plus 26 95.6 1.13 raised to -5. But remember to add the terminal cash flow. Na ndio hii hapa. Terminal cash flow yetu ndio hii hapa. Jika inaonekana hapo. Tulipata around 5.1. 5 ilikuwa around 5.1. Yes, ndio hii hapa. Ndio hiyo kama unaiona hapo. That was our incremental terminal cash flow. So it is in thousand. So kama iko in thousand, so itakuwa 5100 1.13. We said it is a cash flow at the end. So what is the end? The end is here 5. So minus 5. Then we need to minus our total cost. Ndio hii hapa. 10 and 20,000. 10 and 20,000. But it goes in thousand pale. So itakuwa ni 10 and 20. Itakuwa ni 10 and 20. So 10 and 20. You shall get your NPV. You shall get your NPV. So mimi nilipata NPV as 549,316. 549,316.12. That is in thousand. Or let me put it 549.316. Then advice. So advice. Accept the project of replacing the old machine, with new machine because it has a positive NPV. So accept the project of replacing the old machine with a new machine because it has a positive NPV. So meet tomorrow. We do another question. So meet tomorrow. We do another question.